Hi, everyone. Welcome to the Daily Briefing. It's Tuesday, May 17th, 2022. I'm Maggie Lake. Here with me today is Vincent Deloire, Director of Global Macro Strategy at StoneX. Hi, Vincent. It's great to see you again.
Hi, Maggie. Thanks for having me. It's always a pleasure to interact with you and the Real Vision audience.
Fantastic. And it's an interesting day, isn't it? Because we're seeing this big rally in equities today. We have the NASDAQ finishing, it looks like, up with 2.76%, S&P up 2%. I mean, we're still settling here, but Russell up 3%. And at the same time, we have the Fed Chairman, Jay Powell, testifying before Congress, doing his best to sound as hawkish as possible, saying, listen, we're not going to hesitate to keep raising rates till we get inflation under control, even if that means moving past what's broadly understood to be, neutral. And the VIX is down 4%. We did see bonds, the 10-year kind of move back up toward 3%. But what do you make of this market action?
I think it's really a reflection of how overblown these recession fears were. So we basically have, Caribbean and Scylla, like two wrecks that we want to, two perils that we want to avoid. And depending on where we are in the cycle, sometimes we focus. So one is inflation and high rates. The other one is recession and the idea that, the Fed is going to tighten into a mistake. And a couple of months back, clearly the biggest peril was what is perceived to be inflation. And we had such a shift in sentiment with, everybody starting to price in a recession, yada, yada, that you get a day like that. I think people focus more on, I think we also had retail sales that came out pretty strong. Okay, the economy is not in a recession, and we kind of have a typical risk-on move like we'd have, 5 years ago, where you see, small caps outperform, VIX going down, yields go up. So it does bring a sense of normalcy, which is nice. And I do think that on the economy, it's more correct. I think the sort of moral panic around the recession of 2023 was not supported by the data. I mean, we still have an economy that's, as far as I can tell, growing by 11, 12% nominal. So to think that we can slow in 6 months into a recession seems excessive to me. So that's welcome.
Yeah, that's interesting, because you really do get the sense that everyone is looking forward. And when you see things like retail sales, which were up 1%, not sure how much of that was actually higher prices that we were all paying, or how much of it was actual demand. But still, they were holding up. We saw factory production holding up pretty strong as well. But we've had these sentiment readings, like home builders today down, the Michigan last week down at a 10-year low. So I think people are wondering about timing. So do you think that we are not going to go into recession and the economy is strong enough to withstand higher rates, or do you just disagree on when that happens?
Well, I mean, eventually we will have a recession. That's, making a forecast without a time attached to it is, sure. Like all the strategies to go on TV to say they expect more volatility. So the hard question is when. And there, yes, I think I disagree with what seems to be the consensus. One thing that I thought was interesting about where sentiment might be was the Bank of America Merrill Lynch monthly survey. They surveyed, actual, serious money managers, 100 millions of in assets or more. And it struck me that, the biggest worry was obviously the Fed hiking cycle, and we all agree on that. And the second one, by a large margin, was recession over inflation. I would flip these two. I mean, I agree that, for any asset manager, the biggest risk obviously is we at the beginning of a hiking rate, and, because the discount, it's the risk-free rate is in every discount rate. So for risk assets, this is the biggest one. But then after that, I think the biggest concern remains that the economy is too hot rather than too cold. Now, maybe we'll get there. My guess is that we will get there. I mean, at the end of the day, my views on inflation is very much structural. It's very much driven by supply side concern. So really the only way to slow it down will be to destroy a tremendous amount of demand. And yeah, it probably means throwing the economy into a big recession, but I do not think we are anywhere close to this. I mean, we still have You know, real rates are -6%. Financial conditions are still incredibly easy. Yes, you know, if you get chunk spreads, you know, it's up to about 4%, but it's still below inflation. So I think really the investors are kind of, you know, rushing to the end of the play and thinking that it's going to be over in 10 months. It may take 10 years. I mean, if you look at the experience of the 70s, you know, it took 10 years between when inflation started to go out of control after the dollar went off the gold standard to Volcker. That's what it took for the nation to develop the kind of courage and strength to do what it takes to slow inflation. So I really don't think we're there yet. And I think people who worry about recession are focusing on the wrong risk.
Okay, there's a lot to unpack there. I want to stay on the inflation for a moment, and we've got questions coming in. Some of them super specific about how to navigate through this. John, Paul, Roger, Adam, welcome to the conversation. I'll get to those in a minute, but I think it's really important to understand your macro framework here. And I want to come back to growth and inflation, but let's start with inflation because you were early and right on the risks of high inflation. It took a lot of people, including the Federal Reserve, a long time to kind of catch up and lock into that. So are you still expecting that inflation remains high for longer? What is your inflation forecast at this point right now?
Well, thank you. Yeah, so I've been a very early inflationist. Even before COVID, I was worried about inflation. So obviously, I have not given up, but I have come up with a report acknowledging that inflation has probably peaked in March. All else equal, and that is a very important condition, one that is very difficult to maintain given the kind of macro uncertainty that we have. All else equal, I would expect that 8.5 was the high for this cycle, and the reason is that, you know, inflation is really a tug of war at this point between two parts of the CPI. If we can show the chart called the Tale of Two Inflations from a latest report, basically you have your COVID plus energy plus supply chain basket, like the used car, gasoline, air tickets, all that stuff that really went crazy because of the reopening and all that stuff. And there it's moderating, right? I mean, these things cannot increase by 50% every month. So it's not getting much better. I would argue it's just stabilizing. But again, because of base effect, the contribution to inflation is lower. So that's the disinflationary aspect of the CPI right now. And then on the other side, you have the inflationary aspect, which is the stickier part of the CPI, services, wage, and shelter. And for the near term, I would say the next 6 months, the disinflationary wins will be slightly stronger than the inflationary wins. So that should result in inflation slowing. Now, I believe it will not slow as fast as the Fed wants it. Most big banks have forecast about 4.4, 4.5 at the end of the year. I think that's what the Fed has in the ACP. I do not think that will be the case. So what I would expect, assuming no other macro shock, is inflation slows very, very slowly to finish the year at about 6%, which I don't think is enough to get the pivot that the Fed wants. And one thing that is especially worrying to me, and I think really for markets, is that there will be a pause in that slowdown in the summer. So if you remember last year, oil prices were quite weak in the summer, went down to almost $60 a barrel. So that these base effects are going to get harder. So it will look for a couple months that inflation is no longer slowing. And I worry that could be the next down leg for the market. If we have, if by September inflation is still at 7%, there will be kind of a brutal awakening. Right now, we are pricing this kind of recession dovish pivot, thinking that this is going to play out like 2018. You know, the Fed is going to over tighten and then they'll walk it back. I think this is delusional, and removing that delusion could get us to that second down leg in the bear market. So we already had basically more than 20% down on the S&P 500. That's not the hard part. If you remember 2008, the hard part was, September, October 2008, when you get the next 20%. And that could be the trigger for that downfall, because then we'll need to start repricing risk assets for the fact that, all these nice stories that we hear on Bloomberg. Oh, where is neutral? Are they going to go? You know what? No one knows where neutral here. I mean, it's just like a purely academic concept. The Fed will just, navigate, as it sees it, but there is no anchor in the far future that they can follow.
So that is extremely concerning for risk assets. Um, do you think that we are definitely going to see that 20% leg down? I mean, would you expect that to happen for U.S. equities, or does it all have to come together on that sort of supply side of the inflation? If I understand, you're making a difference between that sort of services, wages, and then the more kind of commodity-led supply side. Are you fully anticipating that next leg of the bear market for risk assets?
Well, on the commodity side, it's kind of hard to tell. I mean, so in my forecast, I was assuming that the COVID plus Ukraine plus supply chain basket, the indices stay where they are. So there's no longer inflation. There's no longer disinflation. It's just base effect. I mean, there's disinflation because the base effects are getting easier, but these things are no longer rising in price. For what it's worth, I think that's as good a forecast as one can make. I think with commodities in general, the spot is the best predictor of future prices. With things like used cars, I'm actually trying to buy one right now. It doesn't seem like it's going down.
Yeah.
Maybe it's not as crazy as it was 2 months ago, but we still have the shortages. We still have, I mean, so that's why I'm keeping it where it is. Now these things could change, right? I mean, both ways, by the way. Huh? I mean, it could slow down. I hope it slows down more than I expect, but it could also go up higher. I mean, I can think of a number of inflationary shocks, macro shocks. China is going to reopen. I mean, we have $114 gasoline, oil prices with China and a good chunk of China under lockdowns. And China consumes half of everything. We could see some stimulus out of China. We could also see something really bad happen in, I mean, you see Sri Lanka. You could see the same thing happen in Egypt, in Tunisia, in India, Pakistan. I mean, when you have a kind of balance of payment type crisis, dollar is strong, oil prices is high, and wheat prices are very high for countries that where more than 50% of your consumption basket is made of food or energy. I mean, this is really a dire situation. So you could have shocks either way. So that's why I kind of kept it where I wanted. In the middle, as far as the stickier part, I don't see how that slows. I mean, if anything, it seems to be accelerating to me. If you look at one part of the CPI that was somewhat deflationary, was medical care, which is somewhat odd, right? Because in the middle of the pandemic, usually healthcare costs in the US had risen always faster than inflation, and then this was kind of the opposite. And in April, we saw accelerating medical care prices, shelter also accelerating. So again, there's so much momentum. These things move slowly, so I do not see how services, wages, or shelter decelerate by the end of the year.
So in that case, it sounds like you're saying that we have a question from Ralph saying, what is the biggest risk? What's the right risk to focus on? It sounds like you think the right risk to focus on is inflation because it will mean higher rates for longer, or a more severe tightening cycle than people believe.
Yes, and especially kind of the middle to long end of the curve. In the front, I think it's, we priced a lot of tightening already. The 2-year went from 0 to 3% in a couple of months. Powell's been pretty clear about what he wants to do. He took out the 75, said, okay, I'm going to do 50. I think the market is right for the short end because there's not that much uncertainty there. What worries me is that kink in the curve. So if you look at euro dollar, maybe you have it in the chart. Maybe you can show the chart. Anyway, if you look at euro dollar curve, it kind of falls very rapidly. That the Fed, is expected to raise until close to 3%, and then started in I think it's May 2023. We priced 2 cuts. That's the part that worries me.
Yeah. So let me jump in, Vincent, because if you're talking about persistently high inflation and prices, and you're talking about a Fed that is hiking rates at least through the end of this year, wouldn't that dampen economic growth? I mean, that's why people think there's going to be a recession because, high prices are the cure for high prices and that people will pull back because they just don't, that wages aren't keeping up with inflation.
Right. Well, for now, wages are keeping up with inflation. If you look, my favorite economic indicator, real-time indicator, is the daily Treasury statement, where the U.S. Treasury shows how much taxes it's collecting from the various sources. And there's really three that I'm focusing on. One is the withheld income tax. So this is the stuff that I pay and presumably you pay, people on a normal paycheck, and we get our federal income taxes withheld. That's up 12.5% year over year. Still is today. So, I think inflation is, maybe 8-9%, something like that. That still leaves you like, 3-4% real GDP growth. And then the part that's really booming is non-withheld stuff, individual non-withheld, which, I think it's up 70% year over year. It's huge. Part of it, I think, is the effect of the crypto everything bubble last year. People have a lot of capital gains. But part of it, I think, is also the rise of the economy. People driving Uber, creating content on the OnlyFans or YouTube or whatever. Like they're, and that's the part that I think the Fed does not really see or understand, because its models are based on the BES survey and things that are kind of tilted towards old economy employers. So to me, incomes are rising very, very fast. Yeah, sure, they will decelerate, but not yet. The third part that I look at is corporate income tax collection, and that's growing a lot less fast, around 7-8%. So in other words, and I think we see that in earnings, where we see, earnings are not horrible, but given how rapidly the top line is growing, the fact that your bottom line is not growing as fast, the margins are really getting eaten up. I think that's where it shows first. First, you need to see it. First, earnings slow down, and then you'll see the economic slowdown. That's the proper sequence. So that's why I'm worried about asset prices more than I'm worried about the economy, also because asset prices are forward-looking, right? So
this is a really, really important point, I think, because you're sort of separating out. I mean, we tend to, and we've been told to kind of conflate the two about the wealth effect. And the day we see the stock market, right across the screen, that somehow is reflective of the economy. But you're making a really stark distinction between what's happening in asset classes and to the wealth of those who hold assets, I suppose, and then what's happening in the real economy when it comes to jobs and workers and wages and that sort of stuff.
And I think there is a bit of a selection bias from people who go on financial TV or who make forecasts and tend to be wealthy. So, we see, crypto collapse, and we see, most tech stocks are down like 70-80% from the top. And clearly we think, oh, this cannot last. There will be a recession. For the vast majority of people, the stock market does not exist, or if it exists, just a number that's out there. Like I don't really see people slow their consumption because the stock market is down. In one of the report I mentioned, we think of the economy, I call that the drunk banker economy, which is where basically there's a banker and the bonus pool is good, so he goes out, parties quite a bit, for some tips, and then the recession is kind of a hangover for that. And that's what we've lived for the past 12 years. We always had. It was always a demand problem. So when asset prices went up too much, that you'd have more spending, and then asset price go down. That resolve the problem. I think it is different this time. I think this time you don't focus on the drunk banker. You focus on the waiter. The power has come back, I think, to workers, because right now, yeah, there's shortages everywhere you look at. People. So even if asset prices go down, I think the power of labor has increased. The power of workers has increased compared to that of consumer. The power of the young has increased compared to that of the old. I look at the Atlanta Fed wage trackers, and I look at the income gaps between the educated and the uneducated, the poor and the rich, the young and the old, the white and the non-white. And every time it's the weaker, for lack of a better word, group that's making more money. So that tells me that we have kind of this historical shift. And it is possible that for the first time in 15 years, the fact that the wealthy are slightly less wealthy is not going to throw the economy into recession, because we have so much labor shortage, and this historic expansion in margins of 40 years is starting to work its way back.
That's so fascinating. And that is what many had been hoping for, right? I mean, the US economy runs on the consumer. It's two-thirds, or was two-thirds of the economy, and lower income consumers tend to spend their money. So presumably that would bode well for the US economy. But I don't get
Correct.
the sense that you're bullish, Vincent, for some
No, I
reason.
mean, on the economy, I'm bullish on the economy. I'm just bearish on asset prices. And in a way, like, if you want to take a almost moral view, political about it, you could say this is what we needed.
Yeah.
we
A
had
reset.
four, yeah, we had that. That is the reset. That is exactly that. We had 40 years of capital winning at the expense of labor, margins expanding, and where it was mostly about, owning assets instead of paying for labor, and it is changing. And I think that model kind of died out in the COVID crisis, and now we enter one of these other historical cycles. So I think it's going to be better for generational inequalities, for economic growth, for household formation. But the problem is, asset prices are priced for the old world, not for the new world. I think the new world looks a lot more like the 70s, when you had very strong labor, high inflation, higher rates, higher growth.
So what does well in this? Because any kind of reset or transition is murky, right? It's not immediately obvious what to do. So from an investor point of view, investors, think about the world through assets. And by the way, most of us, especially this is very US centric, but most of us are, because we're funding our retirement. What do we need to think about? What do opportunities look like in that kind of universe, if you're right?
Well, the first thing I have to say is it is going to be harder. Like, there are some environments that are inherently, regardless of what you do, we come from what I think is the easiest environment for asset allocators to one of the hardest.
Mm.
Disinflation is fantastic for asset allocators because it creates a negative correlation between stocks and bonds. So you basically get paid to hedge your equity portfolio. And if you look at the 60/40 portfolio or the risk parity, I mean, all the things that target date, it's all based on that same idea that you can diversify equity risk with long-term treasuries. And 60/40 portfolio was up 8% pretty much every year other than 2008, and of course this year was down 10%, which kind of tells you something about where we are. So we're not going to get there. I think getting 2017, like, you could get paid 3% to hedge, perfectly hedged. The correlation between stocks and bond was close to, long-term treasury was close to minus 0.9. So, I mean, why would you get paid to insure something? I mean, it's crazy. Imagine, like, the car insurance company is paying you, basically. That's what we had for 20 years now. This is not going to come back. So you can look at things that can replace that. The most likely, if we move to an inflationary environment, the biggest risk is going to be inflation, right? So what is your hedge? It's things like commodities, things like possibly emerging markets, things like some value stocks, but it's not going to be as good as treasuries. I cannot envision an asset that will give you a positive real rate of return and hedge your equity risk. So it's inherently, like, your expected return has to go down.
So Adam from Red Bank was asking, it looks like parts of the inflation complex are beginning to roll over while interest rate momentum wanes. Do you think we're on the precipice of stagflation giving way to disinflation? It sounds like you don't. It sounds like you think that we've peaked, but we are in a higher inflation environment. Or do you see disinflation?
Correct. Well, I see disinflation in the sense that we go from 8.5 to 6. So that is disinflation. The rate of change is slowing. The problem is not slowing fast enough. I don't think at 6% we can call it quits. We can say, oh, actually, I finished one of my reports on this idea as a risk. It reminds me of the Iraq War, when George Bush went on the
Yeah, the aircraft carrier.
Aircraft carrier, mission accomplished in the back. The Iraqis welcome us as liberator once again. Yeah, highlighting a new era of peace and prosperity and democracy in the Middle East. I feel that there is a little bit a risk of that if inflation does slow, because I think the reason why Bush did that was he didn't want people to remember too much why we went into Iraq in the first place. Kind of the same thing with the Fed is in a similar situation at this point where they kind of want us to forget the whole, buying, 30 billion of mortgage-backed securities when the real estate market was on fire, keeping QE for way too long, mistaking transitory inflation, calling the structural inflation transitory, and all that stuff. So the ability to declare victory will be seized as soon as it appears. And my concern is that
repeats itself, doesn't it?
Yes, that victory will be a Pyrrhic one, a victory that's worse than a defeat, where, yes, there will be some disinflation, but it's not going to go down anywhere close to 2%. And maybe the bigger risk is actually that the Fed declares that victory and then stops hiking, and then inflation comes back with a revenge in 2023, 2024, which is something that the market is completely not pricing.
You sound like this is going to be, the way you describe it, an era where we're all going to have to become much more strategic in how we think about markets, and more global, by the way, and thinking of something versus something else. So I do want to dive into John and Paul. Both have a question related to the same thing, and that is something that you've been talking about. I've talked about it with you in the past, but you've been also tweeting about it, and that's the Swiss franc, the beloved Swiss franc. So John saying, could Vincent update us on his recent Twitter thread on the Swiss franc and how he views it as a good safety currency, especially given the incredible U.S. dollar strength we've seen in the DXY? Does he still think it will perform quite strongly versus other currencies, including the dollar, in coming quarters?
Well, that is an excellent question. And first, I must admit that call has not worked. It worked versus the euro, which was my original call, but I think most of the real vision were more looking for currency against the dollar, and nothing's worked against the dollar, really. I mean, some of the commodity currencies, the Brazilian real worked for a little bit, but we had such a strong dollar that the Swiss franc, and it surprised me, honestly. I thought, given the volatility that we saw, I was surprised that the Swiss franc did not work better as a safe haven. I cannot say I understand why. I suspect it's because of the Russia story. I mean, it's a big offshore banking sector. Some money is probably leaking out of there. I mean, who knows where the money comes from in Swiss bank accounts. So that would be a fairly benign. So yeah, I still think that is correct. So I would hold on. Versus the dollar, it's difficult. My inclination is that we had a very large move. You don't see the yen and the euro fall by 15-20% in 20 days like we have, without some sort of a mean reverting bounce. If I'm right about the market outlook, meaning that we kind of have a quiet, things settle down in the summer, and we could see the euro, the yen rally, so the dollar index goes down, I would allocate more to the Swiss franc. I would especially allocate to the Swiss franc or to Swiss assets as opposed to Eurozone assets. Keep in mind, Switzerland is not in the European Union or the Eurozone. They have maintained their monetary flexibility. I think Eurozone monetary policy in the Eurozone is going to be extremely complicated because on the one hand, you have 30% plus PPI, producer price, rising, that's destroying the German industry. I mean, they make cars, in cars you have very, very small margins. So if the cost of your input goes up by 30%, you get destroyed. So Germany will need a stronger euro. But at the same time, if you raise rates, you have the problem of Italy and Spain, or really Italy, the debt load of Italy. So it's going to be very complicated for Lagarde to negotiate that. Switzerland does not have these problems. And also the industrial focus of Switzerland is very different. Germany, Italy, the industrial parts of Europe mostly focus on things you can touch, like cars or parts or machines. Switzerland is mostly, the biggest export is pharmaceuticals, and then it's luxury goods. So if we have a shock of input costs, that doesn't matter too much. I mean, there is no input cost for drugs, right? And it's mostly intellectual property.
Hmm.
And you see this divergence in the PPI. I think Germany is up 34%, Switzerland is up only 4%. So if you think about the relative margin of the Swiss industry versus that of Germany, so maybe the right trade would be to go along the Swiss market index versus the DAX index or the FTSE MIB in Italy. And
Yeah,
that's
and
the way.
that speaks to Paul's question, what's the best way to play it? He's asking about FXF.
Sorry, I did not hear the question.
Sure. He's Paul is asking the follow up. What's the best way to play that? The Swiss play. You were just mentioning, Swiss equity versus DAX. I think he was wondering about FXF, which is, it looks like Invesco currency ETF, Swiss franc ETF. Is that another way to do that?
Yes, yeah. Well, I mean, you can buy the the currency directly. I like the equity index part because you're getting a second source of return, in my view. So you get the monetary side of thing, where that you bet on the fact that the Swiss francs traditionally safe haven. They have much more reserves. They have an unconstrained monetary policy. They have a fantastic economy too. I mean, Switzerland, the unemployment rate, inflation in Switzerland is less than 2%. Unemployment rate is at 3%. They will have a budget surplus this year. I mean, it really is a paradise compared to the rest of the Eurozone. So they have so the currency angle is covered. And then on top of that, you get that margin effect where you basically bet on pharmaceuticals versus heavy industry. So
Interesting. Vincent, I want to squeeze one more in from Kyle. And it's something we touched on before, but we weren't super specific about it. How high will the 10-year Treasury yield go? And how will that, I mean, he's saying how will, but I guess you could just say, will that help the little guy? I guess the savers.
it's two hard questions.
Right at the end, we save them for you,
How
Vincent.
high? I would think higher. I mean, if I'm correct about inflation being kind of a more secular thing and looking at a decade of 5% plus inflation, um, you know, the long end needs to move. If we remove that dovish, that kink in the curve in 2023, that will feed to the long end. So the long end goes up. How much up can we tolerate? I don't know. Part of me thinks at some point, we may need to have yield curve control. But in general, I am of the view that we can have higher rate for longer. Like the tolerance for higher rate is not huge, but it's more than what people think. People think, oh, they replay the whole 2018 playbook basically as soon as we crossed 3%, everything went to hell. It may happen in capital markets, but as far as the real economy, maybe it can keep going. And I like the second part of his question, which is very kind of heterodox view, but I can relate to that. The view that in some way, I wonder if low rates really help the little guy.
Mm.
I mean, they made every asset prohibitively expensive. And then they made low rates mean that it's impossible to compound wealth. I mean, for most people, the way out of poverty is you save and you compound at a positive rate. You remove that, it's very hard to make it, and every asset is unaffordable. So it could be that there might be something to his point on higher rates actually helping with this inequality issue.
Yeah, I've been wondering about the same. I mean, it used to be especially as we have, aging baby boomers who are, theoretically, not wanting to be in risky assets. It's an interesting question. We have got to end it there. We just scratched the surface, Vincent. As always with you, we're going to have you back and do a deep dive in a separate thing so we can really unravel some of this, because some of the views are contrarian. But I think it's a perfect example of why it's so important to have this sort of macro conversation and understand what you agree with and what your framework is as you're deciding what to do. And, if you think there's a reset, how to think about this and be more strategic. So incredibly appreciative of you coming on and sharing your thoughts with us today.
Thanks, Maggie. It was fun as usual.
Yeah, absolutely. And, this is exactly the kind of conversation that we're having as part of our global recession series. I'm sure some of you have been able to catch those great interviews, and this is why we're having it, so we can figure out sort of how to position. So, right at the end, we're going to play a little bit more information on how you can find them and how you can get involved in that series and Real Vision. And we'll see you again, same time tomorrow with Ash Bennington. We'll be here with Michael Gayad, which is going to be a great conversation. So, be sure to join us then. In the meantime, take care and good luck out there.
It's a really complicated world out there. We've got massive inflation, recession fears, war in Europe, COVID, China issues. What the hell's happening? Everyone's got an opinion. But who's right, who's wrong? As co-founder of Real Vision, I've got my own view. But maybe I'm wrong too. And I want to go and find out more from real experts, real in-depth analysis. And I've hand-chosen